Life as You Own It with Mark McDougald and Craig Miller.
Remember, you got questions, we've got answers. You may not take the time to educate yourself about the single largest investment and opportunity you have, that investment in the roof over your head in real estate.
We talk about your home, financing, making investments in real estate. We give you the facts, folks.
You know, it's just good old-fashioned horse sense that we like to talk about. And we also throw in some other horse stuff, too, just for fun.
Life as You Own It with Mark McDougald and Craig Miller.
Remember, you got questions, we've got answers. You may not take the time to educate yourself about the single largest investment and opportunity you have, that investment in the roof over your head in real estate.
We talk about your home, financing, making investments in real estate. We give you the facts, folks.
You know, it's just good old-fashioned horse sense that we like to talk about. And we also throw in some other horse stuff, too, just for fun.
All right, we're Life as You Own It. I'm Mark McDougald.
I'm Craig Miller, here to have some fun.
That's right.
Look at the camera.
I hope you're having a great weekend so far, and we hope you had a fantastic week last week. And those of you checking us out for the first time, welcome aboard.
You're in for a shocker.
This is your weekend dose of fun, education, and fun, in that order.
In education.
That's right. What do we talk about in a typical show? Well, we're going to talk about everything under the roof over your head, whether it's the credit score that you've been trying to get a little bit higher so you can either A, get the job, or B, get the best deal on your mortgage or your credit cards, etc., or if it is determining what remodel project makes the most sense for you, saving you the most money each and every weekend, helping you be a wise investor, and so much more.
You'll be a wise something else if you copy some of the comments that Mark makes every week.
That's right. So, folks, if you get it, we want to have fun. We want to help educate you. And you know what? Each and every weekend, we learn a little bit more ourselves because we're required to do a little bit of homework so we can share some good information. And today's show is no different. If you're listening to us on your local affiliate radio station, give them a call and say, good work. We're proud of you for airing such quality material. If you do not have us in your listening or call the radio station, tell them you demand that you will change that station if they're not on the air soon. And remember, you can catch us, you can podcast the show, you can watch us on YouTube. Just go to Life as You Own It. Google Life as You Own It. You can find us there. You can see the bright, smiling, pretty faces of the supermodels that we have speak on our behalf. I'm sorry. They wouldn't speak on our behalf. We speak, they stand, we get them in the screen. So you got to check it out. Remember, call us at 800-270-6425. And I have an apology. Craig, and you have an apology too that we want to make to our listeners. We unfortunately contracted with a company that would provide 24-hour, 7-day-a-week service to answer your calls. So if you've called in and not had a response from us, rest assured it's because we discovered after about 4 to 5 days each time we call in, the calls were not getting answered, the phone wasn't getting picked up, the messages weren't being delivered. So our goal was to be there for you 24/7, and what we did was we failed. And so we have a brand new number, a brand new provider of the service. And what you do is you call. If it's during normal hours, we're here. We're gonna get that question answered to you right away. If it's after hours, you got a nice, warm, friendly voice that yes, we'll now pick up the phone. So again, our sincere apologies. If you know what, I'll tell you, if you called and you didn't get a response from us or reached out, then call us again. We will send you an autographed Life as You Own It t-shirt.
And I even checked it at 2:15, 2:20 this morning, and it worked.
And you know what? Those t-shirts are great for checking your oil. They're great for they're 100% cotton, so you can wash you can work like a chamois. They're very absorbent. So many things you can do functional. So we're going to save you some money, and we're going to send our deepest apologies that we did not deliver on our end, which is getting you the answers that you wanted and deserved.
And it's a lesson for our listeners because what we always say is you've got to read what you're signing, you got to understand everything. If you don't understand it, if you can't say it, don't say it. That's the other rule we like to say. Anyway, if you can't explain to somebody else succinctly, then you shouldn't be signing it. Well, for us, we didn't read very well, and it said 2 to 4 hour, 7 days, if you're lucky, per month. And it was just stuff we misunderstood. So apparently the service wasn't as good as we thought.
That's right. Okay, so remember, reach out to us. Also, the best way is emails. We don't miss those. Emails at questions at lifeasyouownit.com. questions or question at lifeasyouownit.com. Just type in Life As You Own It. You can get to us. We appreciate you following us. We appreciate you keeping up with what's going on, and we want your feedback. Okay, Craig, this weekend, what are the chances you'll be hit by a natural disaster?
For me, personally,
Yeah.
pretty good. Probably 80%.
Right. You need to check out our map. It's going to be on the website. You've got an interactive map that's going to show, you can just click on it, and you can see in the United States what the risk factor is for you being hit by a natural disaster, whether it's a tornado, whether it's a hurricane, whatever it may be, an earthquake. You've got different zones, and you might be surprised, maybe you're not surprised, but we've got that. So, but if moving is not an option for you, we've got some suggestions that you need to follow in the event you are a victim of a natural disaster and your home is damaged. We're going to tell you how you can make sure that insurance company pays up. So stay tuned for that. Also, if I had $1 million, well, I had $1 million, what would I do? What would you do with $1 million?
I'd give away a lot of it, and then I would buy you a nice present. Probably some new lingerie
Maybe
for
some,
you.
Maybe some chocolates. You know,
I'd buy you some chocolates if that's what you wanted.
Yeah,
I'd
take chocolates.
Whatever.
Well, we can agree it ain't what it used to be, but if you're over the age of 70 and want some suggestions as to how to make your first $1 million, we've got some ideas you might want to consider. Craig, are you stressed out?
Yes. Actually, I am just a little bit.
Stressed?
Not today.
That explains the
I
hairline.
mean, I am, but.
Oh,
Man, you
folks,
must be really
already,
stressed
before
out
we
then.
even got through, all right, let me get through what the rest of the show is. If you live in one of these cities, you're probably not alone. Craig shares his best stress reduction tips that are legal in all 50 states. And we're going to share the top 10 most stressed out cities in the United States. Also, mortgage life insurance. What is it? Do you need it? Who gets the money if you file a claim? And who says the Life As You Own It listeners are all beauty and no brains? We've got some insight from one of our listeners we're going to share later in the hour. And that music. Should you stay or should you go? You know the routine, folks. If you're a first-time listener, you send us your scenario. We're going to tell you whether that mortgage, that home, that relationship is one you should stay in or you should get the heck out of. All right, ready, Craig?
Sure
Warmed
thing,
up and
buddy.
ready to go. All
Let's
right.
do it.
Amelia in Chicago, Illinois, called in with the following question. My condo has a lease-to-own option that was agreed to 3 years ago on a 5-year plan. The owner of the building has offered me $5,000 to break the agreement because prices on condos like mine are much higher than he originally planned, I guess. And he has buyers that are interested in the unit right now. All right, this is complex. My thought is that if I wait until I'm ready to exercise my purchase option within the next 2 years, it could be a great deal for me. But I'm also afraid that real estate may drop significantly in the next few years, so it may not pay off at all to buy my condo. It could be a win-win for me and my landlord if I move now, or a lose-lose if I say no and prices dip. Stay or go, guys. That's a lengthy one. Craig, did you get all that?
I got it, Amelia. In Chicago, in your condo situation. See, I have a little opinion on housing this week. I'm going to tell her to make a decision based upon a few other factors other than the $5,000.
So that is not in the spirit of the should you stay or should you go
Stay in the
segment.
condo. Stay.
Okay. Stay.
Stay in the condo. Here's the thing. Your moving expense is going to cost you something. Maybe $1,000, whatever it is, so you're going to eat up some of that anyway. The other part of it is, I don't know if housing will take a significant hit or not in the next couple years, although I wouldn't be completely shocked, folks. Not going to be completely shocked if it happens. Obviously, this guy knows something that you don't know. Most people aren't going to throw money at you to get you to move out so they can sell now. Sit tight, assess the market. If it's still as strong as it is a year or two from now and you want to move, he'd probably still offer you the same deal.
All right. There you go. Stay, stay, stay. Okay, so, Craig, each and every weekend we give the direction of interest rates. We give the actual update, the national average, and let's jump into that now before we get into the more interesting subject matter.
Let's jump right in, folks. National averages every week based upon the same as they are every week before. $200,000 loan amount, 20% or more equity, somebody with excellent to perfect credit. If you've got mediocre credit, loan amount changes, things like that, different from that general average range. It could affect what you're quoted. Keep in mind, these are general guidelines. These are not exactly what you should expect to be quoted, but give you a general idea of the direction of rates. And rates have improved over the past week, folks. I'll tell you that right up front. Improved slightly. Of course, they had gotten worse by about the same margin the week before. So where are we? Well, we're in about the same place we were 2 weeks ago at this point. So again, with this average, that's what you should do right there if you're watching the YouTube video. Folks, here's what we're going to share with you. 30-year fixed every week, 15-year fixed rates, 5-year ARMs, which are, of course, fixed for 5 years, and then they can adjust. And then an FHA, government-backed 30-year fixed rate mortgage. This past week, rates averaged at about 4.2% for a 30-year fixed versus 4.31 the week before, so almost an eighth of a point improvement. 15-year, 3.25 versus 3.38, again, about an eighth. 5-year ARM, 3.55 versus 3.63, and FHA 30-year fixed, 3.85 versus 3.94. So we've seen a general improvement. We're back to where we were before rates worsened the week before last. So you should take action now. I like these rates. Stay tuned. Life as you own it. Back in a few. Hot in here. All right, friends, we are back. Life as you own it. As we shared before the break, rates improved a little bit over the past week. That brought us back to where we were just a couple weeks ago. We want you to take advantage of locking in. If you've got a short-term transaction, you're closing on a home in the next 30, 45 days. If you're looking at a refinance, that makes total sense because there's not a bunch of fees getting crammed in there, and you've done the break-even formula. By the way, I didn't mention that before I shared rates with you. You got to check out lifeasyouownit.com and read the break-even formula. You need to know how long it's going to take you to recover those fees from that refinance transaction if you're paying some. Most people do pay some closing costs and fees when they refinance. However, there are zero cost or super low cost refinance loans. I recommend you compare the two side by side using the break-even formula to ensure you've picked the right thing for your short and long-term planning. This is all part of a plan, folks. It's got to make sense. The math has to make sense. Don't just look at the lowest payment. Look at the overall cost of the transaction and look at how long it's going to take to recover those fees by saving a little bit of money. Remember, your savings on a mortgage is the difference between the interest rate you have now and the interest rate you're going to take on the new loan, the monthly interest savings, not the principal and interest payment. Most times you're resetting that amortization, so you're going from 27 years left and back to 30, or you had 22 years left, you went to a 25, or back to a whole, but going back to a 30, you're like, oh wow, my payment's going down $225 a month. Your interest savings may be $60 or $70 a month. Doesn't mean that doesn't make sense. But oftentimes the quote-unquote savings the lender tries to sell you on is not all savings. It's cash flow improvement by deferring principal payments and resetting that mortgage term. So remember, the break-even formula is crucial. You need to know it before you sign on the dotted line.
Amen. And folks, a little, obviously you knew the break-even formula. Let's say you do it and you go, I'm saving $25 a month in interest. Not a lot of money. Now, how many hours is it going to take you to consummate this transaction? 1 hour, 2 hours, maybe 3 hours? So I'd encourage you to do a little bit of math. If it's truly an interest savings and it's $25 a month, that's $300 a year. It's going to take you 2 hours to do it. Let's say it's going to take 3 hours to do it. $300, that means it's $100 an hour that you're paying yourself for that time. Now, if you're going to have that home for 3 years, well, now you can triple what you're paying yourself in that hour. Now you're paying yourself $300 per hour for the time you invested. So do both sides of the math formula. Make sure you don't buy something or do something and end up paying a lot more. But if it's truly a $25 interest savings after cost and everything's factored in, do the math over the period of time you believe you'll have that loan, and the $25 can turn into a lot of money. So
it's a great point, Mark. I tell people all the time when they think, oh, well, my payment's $14.83. It's only going down to $14.49. That's not that big of a deal.
Yeah.
I'm not going to do it. Guess what? If your cell phone company called you and said, hey, come down to the cell, you know how long it takes to go get a new cell phone. How many times you've been in line?
Mortgage.
Forever, the reprogram, you're waiting forever to get somebody to help you. I mean, you spend 2 hours in a cell phone store a lot of times, and guess what? If that company called you and said, hey, if you'll run down to the XYZ cell phone carrier store and spend 2 hours in there, we'll knock $50 a month off your cell phone bill for the rest of your life, you'd do it. You would definitely do it because you would think, oh, $50 off of my $100 bill, that's half, money's money. Don't make it relative to the size of your payment. Make it what it goes into your bottom line pocket. You can buy some groceries with this stuff, folks. So,
or you can take that $25 and you can start investing it in the retirement plan, or you can start putting it in your child's 529. You can put it in that. That can be the $25 a month
bonds
that you're able to put into that 12 months reserve account that you otherwise don't have. So, do the math, folks.
You got it.
All right. Okay, so let's talk about what are your chances of being hit by a natural disaster. Folks, get to lifeasyouownit.com. We'll have a little interactive map there that's compliments of money.com, money. And it's pretty cool. You can see wherever you live, you can check and see what we'll call it your heat zone, which are the chances of you getting, nasty weather, which will potentially damage your home. And we hope for you that's the worst that happens, is that you have damage to your home, not your loved ones. So in the event that you are a victim of a natural disaster, number one is, first thing you got to do is, and this is before it happens, but also can be after, is document all of your stuff you own. Document your holdings. Make sure that you've got, there are apps that you can get to take pictures of all your, walk around your house today. This weekend, I don't care if you live in you could be in a tornado, and probably there are tornadoes that touch down in probably all 50 states. It's just a matter of the frequency. So take pictures, walk around the house, all the most valuable items, get those documented. And then the next step of documentation is make sure that you've possibly, if it's really valuable stuff, do you have an appraisal for it? Do you have a receipt that you bought it for? Any of the additional things, make sure you've got them. Take 5 minutes this weekend. And at least hit the major items. What are the things about your baseball card collection? Whether it's the piece of artwork that you may have purchased, maybe it's the whatever it may be. Get around the house, take pictures of those things are your valuables, so that you can show that you once owned them. Also, move fast. Gather information as quickly and completely as possible. Try to make sure you uncover and document every bit of damage. Many policies require prompt and early notice of claim. And when I say move fast, right when that has happened, after you call the official, the emergency crew, remember to call your insurance carrier immediately, and make sure that you've got the list for them. You're taking all the pictures. You're giving as much detail as you can about the damage. Next is prevent further damage, but don't disturb the evidence. Make sure you board up windows. Don't start cleanup or other significant work until after the insurance adjuster claims. I know the natural thing is start cleaning up and all those. Don't, just protect it from vandalism and those, but wait until the insurance adjuster arrives before you do any major cleanup. Don't throw anything away, etc. And last is going to be hire a public adjuster. If the claim is large, you might want to hire a public adjuster. Public adjusters work for policyholders, not the insurance company. Typically, they're veterans of the insurance industry, or they worked as contractors or engineers. In most cases, they're paid with a percentage of the claim, usually 5 to 15%. And if all else fails, get help. If your claim is turned down, you can lodge a complaint with your state regulator. Otherwise, you may have to hire an attorney. But if you do these steps, and I want to make sure when you take your pictures with your phone, walk around your house now. Get out of your car, go turn the show on in stereo throughout your house, and walk around and take pictures with your cell phone and email those to yourself. Email them so they're saved somewhere. If they're on your cell phone, your cell phone's lost in the storm or it's a flash flood, etc., it's not going to do you any good.
I tried to hold that one in.
Craig.
That was a powerful sneeze right there.
That was. Well, thank you for sharing.
I tried.
I think we'll appreciate that.
I tried.
You know what? They, too, now know that you are human.
The fact is that the harder you try sometimes to
man.
Control them, they explode on you. All right.
Good thing is that exploded on you and not
Speaking of exploding.
Yes.
Well, I think we're going to be taking a break here in just a minute, but I want to share a little commentary about some updated, not updated, I shouldn't say updated, it's rumor mill stuff, but we're at it again, folks. We're at it again, trying to somehow improve and correct and fix this economy that's just kind of sluggish and barely trucking along by throwing some incentives out there potentially to incentivize you to buy a home. We're back to the instant gratification nature.
A home is a good long-term investment.
It is a good long-term investment. When we get back from our break, though, I'm going to make sure I share some of the updated stuff that people are talking about, because I think it's a bad idea, frankly, and I'm going to share why. And I'm also going to share why that instant gratification mentality could cost you big if you jump into buying that house before you're truly ready. So, Mark, what do we want to cover before our break? I know what we're going to cover. A little should you stay or should you go action.
All right.
Who do we have? Who's reaching out
Reggie
to
in
us?
Omaha, Nebraska emailed the following. I have a $32,000 balance on my mortgage at 5 7/8, and my house is worth around $125,000 to $135,000. Every lender I call to refinance to a lower rate says my balance is too small and it's not worth it. 2 questions. Is my balance too low? And what if I borrowed $80,000 to $90,000 and then took the money they gave me at closing and just paid it toward principal? Is there any negative issue if I did that?
That's 3
Well,
questions.
Reggie, that's a you're going to get we can only answer one of those, and we're going to answer it when we come back from the break, folks. Stay tuned and hear what we give Reggie as his should you stay or should you go scenario advice. Life's doing it. All right, we're back. Life as you own it. Before we took the break, we were answering Reggie, should you stay or should you go scenario. I'm going to recap it for the listeners just tuning in and for Craig, who has a short-term memory issue. I have a $32,000 balance on my mortgage at 5 7/8, and my house is worth around $125,000 to $135,000. Every lender I call to refinance to a lower rate says my balance is too small, and it's not worth it. 2 questions. Is my balance too low? And what if I borrowed $80,000 to $90,000 and then took the money they gave me at closing and just paid it toward principal? Is there any negative issue if I did that? I like the way he's thinking. He must be a regular listener. He's got brains.
He's got 3 questions, though, and he said 2. So, Reggie, we're going to dock you for that in the brain
Right.
power. We still love you, and we're thankful that you're tuning in up there in Omaha. Tell everybody to tune into the show. Answer to question number 1 is we're going to say stay or go on this. Here's the bottom line. This is a split one, Mark. I mean, is it stay or is it go? Depends on what he chooses to do with the money. I say stay if you're talking about just taking that loan under the pretense that you're taking a cash out loan, but you're going to immediately pay it back toward principal. First question was, is my balance too low? Honestly, your balance isn't too low, except that under current guidelines that have been infused into our way of doing business, thanks to our overzealous government regulation, just saying, is the cost associated with just putting this, the basic cost, the title fees and appraisal costs and things like that, just to get a loan put together, are going to cause that mortgage to not be in compliance. In most cases, it's going to be considered a high-cost mortgage potentially.
Yeah.
So it does make it very difficult for a lender to do a balance that low. If you borrow the extra money, I would want you to have a financial strategy to use that money for something productive and have talked to a financial advisor that you trust or have continued to work with over the years and have a strategy with that money. If you're strictly planning on borrowing more money so that it quote-unquote looks attractive and then you turn around and pay it back toward principal, guess what you're doing? 2 things. 1, you need to disclose that to the lender because you're not giving them all the facts on what you're going to do with the loan, and they're going to have a loan they're trying to sell, and it can be messy. But number 2, you're not actually giving yourself any better deal. You're still potentially paying a bunch of costs, and ratio to the $80,000 to $90,000 may not cause it to not be in compliance, but to your $32,000, it's going to be a high-cost mortgage. And you'd really have to do that break-even formula to make sure it's going to make sense. Long answer, bottom line is, here's the deal, Reggie. Get a mortgage plan. Get a bona fide mortgage plan, get a financial plan, and take a look at that equity position that you're in. Because maybe having $100,000 of equity is not the ideal situation for you to be in. We don't know because we don't know the rest of the story. If we were doing a mortgage plan for you, we would figure it out. Do a plan, then see if it makes sense to refinance. The big make or break here isn't whether you get a lower rate from your 5.875, which is definitely above market right now. The big make or break is what kind of financial plan do you currently have. Take action on that. You'll have some positive results.
All right. Okay, Craig, we need to bring you back to that place in time when you were talking about what the economic recovery or the slow recovery and the potential government involvement to stimulate the economy and
Sure.
what you think that looks like for our listeners.
Well, there's a lot resting on housing, folks. That's the bottom line. A lot of our economic recovery, quote unquote, a lot of our economic prosperity over the past decade was truly based upon, decade and a half, 2 decades, was based upon housing going up and up and up and people using home equity to purchase things and continuing to access their home equity like it was a never-ending piggy bank. And that spurred on what appeared to be strong economic growth, only to come back like a snapping rubber band and hit you right in the face, kapow, because we lost all that when home prices dropped. So what are we doing? Our government says, oh, housing numbers this past week came in lower than we expected. We don't like that. Maybe we should come up with some incentives again like we did 5-6 years ago with first-time home buyer incentives, tax credits, things that don't have to be repaid, maybe things that do have to be repaid. What can we do to spur on more people buying homes? Guess what, folks? It's not the answer. That's not the answer to our economy recovering. We would like to think so. It's really not. It's instant gratification. It's short-term thinking. It's band-aiding the problem. And here's what ends up happening. Guess who bites the hook and gets sucked right into something that could turn out to be a negative for them? The consumer, you. Because you're also focused on instant gratification. Now all of a sudden you're saying, oh, I can get basically paid money to buy a house. I'm going to do it because I want to own a home right now, even though I don't have any money saved, I don't have a financial plan, I haven't started to save for my kids' college, I don't have any reserves. I'm going to do it because it's out there. I hope the government is really thinking through this time, because last time when it was done, did it help a few houses sell? Sure, but it wasn't near the impact that everybody thought it was going to be. And did it ultimately net any real gain in housing, home prices increasing, recovery in any certain neighborhoods or local economies? Not really. So my thought is, if you have sound financial practices and principles in place for having a plan, having your reserves built up, being secure in your employment, all the things are lined up that you would go about before making such a large investment, it's time to buy a home. If those things aren't happening right now, guess what, folks? There's a reason for it. If it's not happening enough, according to what the government expects to be happening, it's because our economy isn't recovered and people aren't in a position to be buying a home. So it goes hand in hand. And I just want to give that little commentary. I want you out there on the street looking at houses, thinking about this stuff before you vote with your instant gratification instincts or reactions, I should say, before you think that, oh, that makes a lot of sense. If the government does it, I'll buy a home. Slow down and think about it. Are you really ready? And that's what I've got for a little memo on that, Mark. What's next, buddy?
All right, so you're over the age of 70, and
No,
you haven't
I'm
made
not.
your first million yet. Well, let's talk about some opportunities for you to get a cool million. And remember, a million today isn't what it used to be, but it is still a million. I'd take it. Rosa, would you take a million?
Heck yeah.
Right.
Rosa
Although
would take
some
a
people are like, I don't
million.
want a million because I have to pay all those taxes. Yeah,
Still.
I'll take the million. All right,
Take
so
the $500,000 and give the other
take the
half to our
$500,000.
wonderful government.
all right, number one, an option is that you can stay tuned to Life as You Own It, and you will understand what ye of 70 years or older will need to do to get your million. Life as You Own It. Hang out with us a little longer.
Alrighty, friends. Alrighty, we are back. Life as You Own It. How to make that million after age 70. We started talking a little bit about it before we hit the break. And we're going to give you some good ways. You can do this. You can do this. Mark's going to have some of the keys here.
You may choose to do it. You may choose not to do it. Either way, we're going to give you some info so you can make the choice yourself. All right, number one is, as we know, if you started in your 20s, firstly, if you started in your 20s investing, putting money away, and diversifying those monies, then you've got a good chance of having earned your $1 million the hard way. Or actually, I'm sorry, the easy way, because the easy way is to have a diversified portfolio and let time be your friend.
It's
However,
the easier
that is
way,
the
for sure.
easier way. However, if you're over 70, you're going to have to be a little more aggressive.
Because you don't have that long, folks.
That's
Just
right.
want you to know. I want
And
you to think about, no, you might have 30 good years left in you. Just say, you could probably get there, but you're not going to care much by the time you get to 100. You're like, what? Money?
There you go.
I won't even know how to count.
well,
All right, keep going.
if a 70-year-old that invests wants to get to $1 million by the age has nothing wants to get to $1 million by the age of 85 is going to have to put away $2,300, a little over $2,300 a month, each and every month, and have a 10% rate of return to get to that $1 million by age 85. So it is possible. A 10% rate of return, putting aside $2,400 per month. Kind of a challenge, but it is possible, folks. You can do the math. You can get there. And the equity markets have indeed returned an average of 10% per year since 1926. So if you're well diversified, now do not go out and think you can pick a couple winners and suddenly your $2,300 is going to turn into $23, quite likely if you're not diversified. And then, well, where did we get?
And
Another
remember, you're going to be
option.
taxed
You
at
got
some
it.
point on that money. You're going to have capital
You're taxing me
gains.
right now by raining on our listeners' parade.
I'm just going to say, if you think you're at the very end and
Yeah.
you've gotten that $1 million and you're ready to spend it, you could just not pay
You
your
got it.
taxes, spend the money, and then, oops, I owed a bunch of taxes.
So you
when I
do
got the
have,
call.
and it's not unrealistic, a
I'm
10%
just
rate
kidding.
of return has happened. That has
It
happened
has.
in equities. So you do, there is the opportunity. Another is you can start your own business. It's never too late to become an entrepreneur. and it is one of the greatest ways to become that millionaire, to become wealthy. But what it will take is a business plan, actual strategy, and a lot of hard work.
I agree with this one. Investing in yourself, folks. And by the time you're 70 years old, you've learned a lot. You may have acquired some skills, some knowledge you can apply to help others, make a living for yourself, make some money. If you know how to do it, if you need help with the business plan, get help. What do we have, Marcos? Should we stay?
All right, should you stay or should you go? We have, let's see.
It's Amy.
Do we have Amy?
In
Gotta pick up Amy in Parkville, Missouri.
She's right there.
First, I love your show, and it's been a great resource as I prepared to buy my first home this year. I love you, Amy. I love you. You're a wonderful woman. I'm in a sticky situation and need to know if I should stay or should go. I was laid off from my job of 6 years a couple of days ago. Well, we're sorry about that, Amy. I'm skilled and in a fairly high-demand industry, so I think I'll find a new job fairly quickly. However, my situation is this. I am contracted on a house, and I'm supposed to close in about 6 weeks. My realtor is telling me not to say anything to my lender, nor is she wanting to advise the sellers of what's happened. Her thought is that since I'm actively looking for a new job and will likely find one before closing, it will all work out fine and we have plenty of time. I feel really uneasy about this. Should I stay contracted and sit tight, or insist we let everyone know the situation? Please help. Thanks. That is a good question, Amy. Craig, what say ye?
If Joe is telling everybody, it's go, 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 sister. Listen, you can't not explain what's going on to your lender. Your lender needs to know everything that potentially could affect your financial transaction from the minute you sign that application. So, you've now lost a job? Okay, not a good thing. It sounds like you're confident you'll get a new one. Call them up. Hey, guess what? Got laid off. I'm actively looking for a job. We've got some time. There's some things you have to document and do before you can close on the house. One of them being you're going to have to at least collect a paycheck at the new job. So you may not get that first payday by the time you're supposed to close, and that could throw off your closing. The sooner you let everybody know what's going on, the better you're going to be. As far as stay or go on that realtor, maybe I'll opine on that another time, but somebody needs to have a serious talk with this realtor about his or her strategy on keeping quiet, because that isn't going to help anybody in this situation.
Devil's advocate, depending on the timeline of which she gets this contract that she believes she's going to get, should she have that seller, now she's under contract, and it's subject to qualifying for a mortgage. So technically, until she's denied for the mortgage, which she is under contract and did so in good faith, I don't know that that would immediately release her from that contract anyway. So I think communicate with your realtor, but the reality is if you don't have a job and you can't qualify for the home, then why keep this house under contract? If you believe you're going to get that job, I think let's look at that real estate contract closely, and even if you disclose to the sellers, which you're not necessarily obligated to do, because if you think you can get another job, you can get another job. They still have it's subject to your financing. They just might require a new pre-approval letter, which you may not get one issued. So a little bit sticky situation. And I would, but you got to let your conscience, let your pillow.
Your lender needs to know. Period. It doesn't
you
matter.
got it. No question.
There's too many things.
Let your pillow be your conscience, and disclose what you're contractually bound to disclose. We believe that taking the high road is the best road at all times. Okay,
making that $1 million bucks after
making
70.
$1 million.
What's one more way, Mark? What's another way?
Right, another way we have is you can delay Social Security. Here's a scenario where a couple in which both people are age 66 and entitled to the maximum Social Security earnings delay payments up until age 70. That would result in an increase of 32% in payments, $845 a month for each person, or $1,690 for the couple. If the couple takes that extra money, invests it in S&P index fund, and averages 7.84 rate of return, by their 92nd birthday, they will have $1 million. So
it'll be worth $600,000 in today's dollars.
Depending on their tax rate. When we come back, folks, we're going to share just a couple other ways you can earn your $1 million. Life as you want it. Stay tuned. All right, right, folks, we're down to the last few minutes of the show. We appreciate you hanging out with us for this hour. And remember, you can catch all the latest and greatest if you just Google Life as You Own It. You can podcast the show. You can watch us on YouTube. And you can follow all the goings on. And we encourage you, reach out to us, 800-270-6425. 800-270-6425, and we know you're possibly listening this to the weekend if you're listening to it on your radio, and so you can reach us at this time. You can reach out, leave a message, and we will get back to you quickly, promptly.
Hey, we'll throw out one more way somebody can make $1 million after 70.
All right, another opportunity is to purchase real estate. Now, we can agree that this is proven historically to be a low rate of return at 2 to 3%, just in the range of inflation, which is a good long-term investment. But if you happen to get a 5% rate of return on your investment in real estate after 5 years, that's a 25% increase in your investment if you put 20% down on that property. So recognize that after enough years, if you have that appreciation in real estate at the age of at 5%, then you could actually have $1 million in equity, of which some portion of that would be taxable as you are in your early 90s. So paying down that mortgage, the remaining and resultant equity, as you're in your early 90s, you would now have an increase of your net worth, depending on how much you had put into it, of almost $1 million in home equity. All right.
Let's talk about stress. Speaking of $1 million, okay,
Yeah.
folks. CNN Money's got a ranking of the most stressed out cities by commute times, hours worked, crime, unemployment, poverty, and more. So these are the factors in general that people cause stress, basically. So we're going to run through them real quickly, and then we're going to share this astute listener of Life as You Own It's opinions that were sent to us a couple weeks ago, and we wanted to share it. Give them some props. Okay, so stressed out, folks. Number one, what do you think it is? Come on. Take a wild guess. New York City, of course. It's a bustling town, and it's just a lot going on there. I visit there here and there.
Spreading the blues.
You see the stress happening. There's some cool stuff there, but it can be stressful. Number two, another surprise, not surprising at all, Detroit, Michigan. Even though they got a good ball team, everything else about it seems to be stressful. Los Angeles, doesn't surprise me once again. Burning through the top 10, folks. Number 4, Riverside, San Bernardino. Houston, number 5. Chicago's number 6. Miami, number 7. New Orleans, Louisiana, number 8. And Atlanta, Georgia, Memphis, Tennessee, round up 9 and 10. There's plenty more. You can check it out on cnmoney.com. And your market may be in there, may not. One thing in common, none of these are small cities. None of these are small little towns. Want to lower your stress? Move to a nice little sleepy town. All right, Mark, let's hear from our smart guy that listens to the show every week.
All right. Well, we want to thank Michael for checking out the show. He's a KMBZ listener, and he shared some information with us. He and a friend were discussing the housing recovery, and he very astutely opined that if the economy recovers strongly and the Fed will raise interest rates. We definitely agree there, but that forces up the cost of money and gave some scenarios by which investing those dollars may be challenging to get a rate of return if those interest rates are high enough and reach a certain breaking point. Or if the economy falters and no one can buy a house, then when we need to liquidate those investments, which would be the housing investments, then also creates a conundrum of sorts. Now, I've greatly shortened that which was his very astute opinions, but bottom line, folks, is as the investment in real estate is something that comes across your financial planning discussion, make sure that it's long-term, make sure it makes sense for you. You have a business plan, you have a game plan, you've got a financial plan, and it doesn't matter where interest rates go. As they go up, they're going up because our economy as a whole is strong, which means all investments, most investments, are yielding a higher rate of return. Yeah. To include housing, it is all relative. So we thank Michael for his feedback. We thank him for listening to the show, and we encourage you. Send us your feedback. Remember, call us at 800-270-6425 or hit us up at lifeasyouownit.com. Craig, thanks for hanging out with me today.
I always enjoy it.
It's been a treat.
Good times.
All
Good
right.
times, Mark.
Remember, folks, you've got to always
stay classy.